Hi. During last week, we've done two examples of the market models. One was a partial equilibrium and the second one was a general equilibrium where we had just markets for two commodities. Okay, and we learned how to find equilibrium in those models. So today we're going to continue with the static analysis. So with just finding the equilibrium of the model, but we're going to broaden our collection of models we are going to use. Because as I mentioned before, we're going to be using very similar models, but we're just going to be making them more and more complex and introducing new tools to get as much out of these models as we can. Okay, so the next category of models is going to be macroeconomic. First two models were typical microeconomic market models. So now we are moving to the macroeconomy part. And we're going to start with national income model of closed economy, which means that at the moment we are not considering trade with the outside world or borrowing and lending from the outside world. Those are the things we're going to introduce a little bit later. Of course, this is a Keynesian national income model that you are going to be doing in very much detail during your Introduction to Macroeconomics class. However, because probably at this moment you haven't done it, I'm going to start by explaining what are the components of this model. Okay, and our national income model that we're going to start with is given by these 5 equations. And we're going to identify what are all those 5 equations in a second. However, before we do so, let's just figure out what is in this model. Remember, this is a macroeconomic model. So we are talking from the perspective of the entire economy. Okay, what does it mean? It means that we are working with aggregates. We are not interested with individual customers. Actually, when we talk about macroeconomics, we usually talk about households rather than customers. We're not talking about individual firms, individual companies. We are talking about all households. We are talking about all companies. And for now, we're going to also assume that there is a third participant in the economy, which is government. But of course, we're not going to put that much attention into companies' decisions and government decisions at the moment. But what do I mean by that? You'll understand in a second. But look, what do we have over here? First, we've got this Y. Y is simply GDP. This is gross domestic product. So this is the value of all the goods and services produced within 1 year in a given economy. Let's just say 1 year, like some time period. Now, because we are talking about aggregates, we are interested in how much the entire economy is producing. So when you look at Y, so GDP, you can look at it from different perspectives. Again, this is something that you're going to be discussing in detail during macroeconomics class. Just let me explain one thing. Look, if we have the economy and we produced some amount of goods, then what is happening with the money that we got with after selling these goods? Well, this money goes to the factors of production, right? So to the workers, to the capital owners, and let's just say to entrepreneurs, so they get profits for their ingenuity and managing their companies properly. So look, everything that has been sold in the economy is going back as an income to everybody inside this economy, to all the factors of production. But look, those factors of production are actually households, right? Because in the end, owner of capital is a human that is a member of some household. Owner, a worker, is also a member of some household. And finally, even the profits go to entrepreneurs who are also members of households. Of course, part of the profits can also be reinvested, but we talk about general picture right now, just to understand what is the logic behind the behind the model. We don't need to get into too much details on how everything works. This is for your macroeconomics class. Okay, so look, this GDP that we describe over here is a source of income of everyone in the economy. So, in other words, if we sum up incomes of everyone in the entire economy, we will get GDP. But look, because we can calculate this GDP from perspective of incomes of everyone, let's call it simply income. Okay, so we know that the GDP can be calculated from the income side, from the production side, right? But of course, look, we've discussed, and we said that this income comes from selling goods to the participants of the economy. So you can think of it as a supply side of the economy calculation of GDP, but somebody needs to buy it. Of course, we are ignoring the discrepancy between what was produced and what was sold. We are assuming that everything that was produced was sold. Of course, we could add changes in inventories here, but it would just cloud our model without adding anything meaningful, at least at the beginning of the analysis. And again, this is more of a topic for your macroeconomics class than Introduction to Economic Analysis class. So look, the second thing that we need to consider is the spending side of the economy. And this is what you see over here. We've got this category called A, which are aggregated expenditures. Aggregated expenditures is simply a sum of all the types of expenditures we've got in the economy. Okay, but as you see, from this equation, we've actually divided those into three different categories. One is C, and it is consumption. Consumption are simply expenditures of households on everything they buy. Okay, this is we're going to get into details how consumption works, but for now, let's just list all the categories and explain what they are. Then you see this I and G. I is investment. And investment are spending of companies on capital goods. So how much capital, how much new machinery companies are actually purchasing? And finally, there is government spending. But what is important to remember is that this is government spending on goods and services. What do I mean by that? Look, government has generally two different types of spending. Of course, you can divide it into many categories, but from our perspective, the two are important. One category is the spending on goods and services. So when government pays a company to build a road, result of that is a new road, right? So in this case, we see that government gets something in exchange. When government pays its workers to run the country, government also gets something, their services. So in those cases, we see that actually when government pays somebody, the result is production of a good or provision of a service. However, government can pay unemployment benefits. So government can pay money to people that do not work. But in this case, government do not get anything in return. So in this circumstance, we will not calculate this into government spending on goods and services. So when we have benefits, so when government pays to people for some reason that we decided that it's important to pay, like benefits, unemployment benefits, the money we is received by unemployed, well, we cannot calculate it to aggregated expenditures because even though the money is spent, there is no good or service resulting from this spending. Of course, this money will get to households and they spend it on consumption. So as you see, this spending is actually already included over here. And look, as you can see, I added 2 zeros over here next to investment and government spending. Those zeros are denoting the fact that we will treat those two variables as exogenous. So this is exogenous investment, or more the term that is more familiar in the context of macroeconomics, autonomous investment. What does it mean, autonomous? Autonomous means independent. In this context, it means that it's independent from the level of income. Whether this is 100% true, it's a little bit tougher question. Again, that should be explained within macroeconomics. However, for us, it's a justifiable simplification because for now we want to just focus on other things than how GDP influences investment. And look, so we basically assume that based on some calculations, their expectations, companies have decided to give some level of to purchase some level of capital goods, and we are not trying to explain this within the model. This is why those are autonomous investments. They are exogenous to our model. Those represent exogenous variable. And similarly, we do the same thing with government spending. Also at zero. This is autonomous spending in a sense that it's independent from the level of GDP. Again, whether it is true, 100% true in reality, is inconsequential here, in a sense that for now we want to focus on different things. So we're not going to be dwelling on how government makes the decision on how much to purchase. For now, we're just assuming that government decided, you know, we're going to purchase this and this much. This is it. Okay, so these are the three components of the aggregated expenditures that we've got. But look, as those two are given exogenously, their autonomous investment and autonomous government spending, you see that consumption in this case is actually explained by equation 3 over here. And so now let's look at this equation 3 in detail. Look, in equation 3, we see that consumption is equal to A plus B plus YD. So maybe let's just start by explaining what is YD. Of course, we see the explanation below, right? YD is 1 minus t, and in turn we know that t is equal to lowercase t times y. Okay, so YD is income minus t, and t are taxes. Okay, let's go about it like this. We know from here that t are tax revenues. So this is how much money government collects from households in the economy. Right? So, now how does this collection of tax revenue goes? Look, here we see how it goes. Generally, we are assuming here that we've got some tax rate, T. So, because it's a rate, so this is a number between 0 and 1, or between 0 and 100%, we of course assume that government is having some tax rate, so it's bigger than 0, but also the government do not tax everything, because if the tax would be 100%, there would be no motivation to work, so nobody would be working. So we are assuming that this is a number between 0 and 1. And look, it goes like this, that when households are paid income, part of this income goes into government in tax revenues. How much of it? Well, government takes t times y. So if t is, for example, 20%, it means that government will take 20% of what you made, and this is going to be the money of the government. Now, what happens with the rest? Well, the rest goes to the households, but now they can actually spend it. So look, this is the income of the households, but before it goes to the household, part of it goes to the government, and what is left for the households is YD. YD is disposable income. Okay, so again we see what disposable income is. This is how much money you will have out of your income if government takes taxes. So it's y minus t times y, right? Or we could take y out of the brackets here. This is y times 1 minus t. Alright? Does it make sense? Look, if you make $100 and tax rate is 20%, then it means that 20% times $100, $20 goes to government, and out of this $100, 1 minus t So 1 or 100 minus 20%, 80% goes to you. So you get $80. Okay, so we see that before government actually collects the money, we've got income Y, and after government collects the money, what we've got is disposable income. Disposable income is this part of the income that customers can actually spend on goods and services, or households. Okay, and look, this actually gives us a perfect explanation of the last two equations. So the only thing we need to now consider is the equation for consumption. Okay, so now let's get into details to that. So we've got the equation for consumption is this. So look, we know that consumption depends on the disposable income, right? So income after taxes times some B that should be between 0 and 1. Okay, what is this? We will explain in a second. Yeah, so look, definitely how much you're going to consume, how much you're going to spend on consumption depends how much money you've got. However, let's forget about it for a second. Let's imagine that our income is 0. We have no income at all. Do we need to still purchase things? Of course, if we want, we're going to die, right? We need to buy food, we need to pay the rent, we need to pay for the utilities. Without those, we cannot live. However, how can we do it if we do not have any income? Well, there are 3 different ways to do it. First, you can use your savings, right? If you have some money left from before, you can use it to finance consumption. Secondly, you can take a loan from the bank, right? Or from somebody else, and you can finance your consumption with this. Finally, if those 2 are no longer options, you can use the third option, which is selling something you already got to finance your consumption. So this part of the consumption, you can think about it, are those necessities that we need to have. Doesn't matter how little money we've got. So even if we do not have any money, we still need to purchase them. This is why this part that you see over here of the consumption is called autonomous consumption. And again, this is the part of, similarly to the logic we used when we were defining investment and government spending, this is the part of the consumption that do not depend on the level of income. Okay, we are assuming, of course, it's positive, which makes perfect sense, because we need to buy something even if we are without any income. Of course, we are assuming that investment and government spending are positive as well. Okay, now that we've got defined autonomous consumption, we can proceed with P times YD. Look, B is between 0 and 1. Again, this is a rate. This is a number between 0 and 1 because, again, we are assuming that people are spending at least some of their income on consumption, some of their income on consumption. Of course, if you do not have any income, you at some point, if you wouldn't spend your income on consumption, you would run out of other options. You would die from starvation. Of course, if we have income, we spend part of it on consumption. Secondly, we are not assuming that this is one. For various reasons. However, the simplest is if we would be spending everything on consumption, at some moment we wouldn't have any capital in the economy because we wouldn't be saving and we would again die from starvation. So in this case, putting the restriction that B must be somewhere between 0 and 1 is really okay. Now, but what is this B? Look, you can look at this B in a very specific way. Look, if I'm going to take this equation and I'm going to calculate the derivative of consumption, with respect to disposable income, I'm going to get B. And this B is somewhere between 0 and 1. Okay, so what is this derivative telling me? If the disposable income increases by some small amount, and consumption increases by B. This is mathematical interpretation. However, we would prefer to have economic interpretation. So let's assume, even though this is not technically true, although with this model it is perfectly true, because this is a linear model. What do we have here? If income, disposable income, increases by $1, spending on consumption increases by B dollars. So B is telling us by how much consumption is going to grow if our disposable income is going to increase by $1. This is why B is called MPC, marginal propensity to consume. Okay, it just tells us how much out of one additional dollar households are going to spend on consumption. Okay, so look, now we've got it all. The only thing that we haven't discussed is actually equation number 1, right? We've explained what is in here. We've explained what we've got in each of these equations. But what is this? Look, if we talk about equilibrium, we need to have some equilibrium condition. And look, in national income model, we say we've got equilibrium in the model if income of all the households in the economy is exactly equal to the level of aggregated expenditures. So you can think about it like this is what economic agents in the economy wanted to purchase, and because those purchases were made, people made this income. So for equilibrium to persist in this model, we need to have income equal to aggregated expenditures. And look, this should tell us another important thing. What type of equation is this? Well, this is equilibrium condition. Okay, so now that we've identified what is the equilibrium condition for this model, let's dwell on other equations and what we've got in those other equations. So look, in equation number 2, what do we have? Aggregated expenditures are equal to the sum of the expenditures of households, consumption, companies, investment, and government spending. So what do we do here? We defined aggregated expenditures as the sum of consumptions of different entities, different players in the economy. So this is a definitional equation. Okay, so now let's go to equation number 3. Here we've got consumption expressed as a function of disposable income and autonomous consumption. So this equation is showing us how consumption is going to behave in responses to changes in disposable income. So this equation must of course be behavioral equation. Okay, so now let's move to equation number 4. Look, this equation in turn is telling us that disposable income is equal to the difference between income and tax revenues. Again, this is a definition, so this must be definitional equation. Okay, so we are left with the final equation. This equation is telling us that tax revenues depend on level of income in the economy. So it shows us how tax revenues are formed depending on the level of income. Again, it shows us the behavior of tax revenues when income is changing. So again, this is a behavioral equation. So, as you see in this case, we've actually got all 3 types of equations we were discussing, because this is a conditional equation, but we prefer to call it equilibrium condition because it's a more detailed description. It distinguishes it from the optimum condition. So now we have all 3 possible cases within this model. Okay, so what should we do next? Now that we know this, maybe we should identify what is endogenous and what is exogenous. Look, let's start actually with exogenous variables. Look, we already said that the level of investment and level of government spending are actually decided outside the model. What does it mean? It means that we are not trying to explain it. We are taking them as given. They're called autonomous. But autonomous is just another name for exogenous. So exogenous variables definitely are investment and government spending. Okay, but by the same token, we said that consumption, part of the consumption is autonomous. We need to have it. So clearly autonomous consumption must also be an exogenous variable. Okay, and there are two more exogenous variables here. But look, those three, 1, 2, 3, are exogenous, and they are formed in the form of a constant. However, we have two more variables that we are treating as exogenous. One of them is marginal propensity to consume, so B, because this is also a parameter in the model, right? We are not trying to explain the value of it. However, it's in a different form. It's still exogenous variable, but it's a parameter. And the same thing with the tax rate. We are also assuming the government has actually decided about some level of tax rate, some percentage of our income that we need to pay to the government. So we are not trying to explain either of those within the model. We are taking them as given. So all those things in red, all variables in red, are exogenous and they are constants, and those two are also exogenous, but they are parameters in our model. They are coefficients. That is a better actually description, but it's inconsistent with your book, so I'm using parameter as it's preferred in your book. Now, what does it imply for everything else? Everything else in this model is endogenous. So we can, using these 5 equations, we will be able to actually establish, I'm sorry, I just ran out of colors. I'm gonna find something wrong. I think this is orange. It's supposed to be orange. So we can see that all those which are repeating all over the system are endogenous variables, right? So using this model, we can calculate the value of income. We can calculate the value of aggregated expenditures, consumption, disposable income, and taxes. And look, it's no coincidence, although it doesn't need to be like that everywhere, every time. But you see, they all appear over here. If a variable usually appears on the left, there's a very big chance it is endogenous, which makes perfect sense because if you define something as equal to something else, and this something else depends on yet something else, you got this net of interconnections between the variables. Okay, so look, at this moment, we know everything we need to know about national income model in closed economy. And we also learned that there is 5 variables in this model. So technically, we could put this all into matrix notation, create out of the system of 5 simultaneous equations with 5 unknowns. We could build a big, relatively big system in matrix form notation. We could solve it for all those 5 variables. However, in this case it's overkill, as you will, because we don't need to get into such complicated exercise to do something that simple. And actually, the very important thing to remember is that in economics, we are rarely interested in the values of all the variables in the model. We usually want to focus our attention on some key variables. So, depending on how we want to structure our problem, we can find a solution for a different number of those variables. And this is going to be a topic of the next video. in the next video, we're gonna actually learn how we can, out of the system of 5 simultaneous equations, build different type of smaller systems to get the information, equilibrium solutions that we actually want to see. Okay, so this is the end for the introduction, and we're going to continue in the next video.